Hey everybody, it's Pete. How are you today? Welcome to a new episode of Stocks for Breakfast. We haven't done these in a while. Today we're going to actually be answering a question from you, from the community, and it comes from Sophia today, and it's in regards to hedging a stock portfolio. So I'm going to pull it up on the screen. We'll take a quick look at it, and then we're going to come right back. So what Sophia's asking is, well, first, Sophia, I want to thank you for watching the videos. I want you to know how much I appreciate it. Could you share some of your experience in regards to hedging a portfolio, strategies and whatnot? And this is really the biggest concern because a lot of people right now are talking about inflation, the threat of the market going down. So essentially what hedging is you are working alternative investments from your portfolio, from the stocks that you bought. In case the market goes down, you are sort of protecting against the profits that you have by either making money as the market goes down or what's known as short selling, which could also be a way of making money. So there's pros and cons. I'm actually going to take there's costs to hedging because you either have to buy something else in the anticipation that that security is going to go down, or you could technically short sell, which is something a lot of people do. The interesting thing is a lot of people don't factor in that you could just go back into cash. But a lot of people don't do that because they are longer term investors and want to be in the market. They don't want to lose their position. So we're going to touch on this topic in a lot more detail. So stick around and we'll be back in just 1 minute. So first I would like to ask if you find these types of videos helpful and I provided value to you and you come back for more, I'd really appreciate if you smash that like button and subscribe and hit the alerts so that you get new updates. So at the beginning of every video, I want to make sure that we remind everybody that what we do is for educational purposes. Always seek your own financial counsel and make your own decisions. So what we're going to talk about now is an interesting way of hedging. So we described hedging as a way of sort of balancing your stock portfolio where as profits go up, you're kind of okay, right? But if the market reverses, which there's a lot of talk about inflation right now, how do you protect those gains with a different type of investment? So one of the first ways to do that is actually having a stop loss in place. But a lot of longer term investors aren't necessarily using stop losses on their profitable trades because they're long-term investments. They like the company. They believe in the company. So generally, they'll sit through the ups and downs. But Sophia's question is a really good one about, well, what if I don't want to have negative returns on my portfolio? What do I do? So one of the most common ways of hedging a portfolio that obviously has a cost, which is buying put options on those stocks that you own or buying put options on an index. So generally speaking, the market and stocks follow the index, and most fund managers are trying to beat that index, and your stocks are trying to beat the index. It's a very popular statistic that how did your portfolio do, or how did your stocks perform against the S&P 500? Generally, that's the one that most people compare to, and most funds compare to. So what you would actually do is if you're expecting the market to go down, but you want to maintain your portfolio, you could buy puts options on either the market or, in a second, we'll get to stocks that already have what we call bearish order flow. And I'll explain what that means in a second. I'm also going to teach a very advanced strategy, a way that one of the people that I traded with probably back in 2015, he was a very, very active trader, a seven-figure trader, multiple seven-figure traders. And I'm going to show you actually how he traded and hedged all day during the day. So if you're not familiar with what a put option is, a put option basically is a contract that allows you to profit if a security goes down. So in other words, if a stock is at $100 or the S&P 500 is at $450 and you believe it's going down, you could buy a put option on that. And if it goes down in a certain time period, you will profit on the way down. So if you have a long portfolio, long means that you bought stock, all of the stocks that you own are up at whatever level they happen to be, and you believe that the market and or those stocks are going to go down for whatever reason, but you don't want to get out of them, you would buy a put option with the anticipation of the market going down. So you make money on the put as the market goes down. In this case, if you buy an S&P 500 put option, and if your portfolio goes down, and the market goes down, you'll be losing money on the portfolio, but you'll be gaining money on the put because you basically placed a bet that the S&P, in this case, the put option that you bought, would go down. Now, they're not always 1-to-1 ratio, but if you buy correctly, if you understand time value, if you implied volatility, there's a whole other course that you can take a look at for buying and selling options. Not my course, I'm not selling it to you. So that's one way of doing it. Now, the downside of hedging using options is expiration. So what happens is it's a contract expecting, in this case, for the market to go down by a put option, but it has to happen within that certain amount of time. So it could be a week, it could be a month, it could be 3 months. Whatever time you buy, the more time, the more expensive that hedge will cost you. So that's one way of doing it. A second way of doing it is actually short selling other stocks. Now, this is what I want to talk to you about. One of my friends, his name is Andy. What he would do during the day, and I'll show you exactly how he did it, is he would work positions. And essentially what he would do is during the day, now there's two different kinds of conditions. There's a condition where the market is in a raging bull market to the upside, very similar to what we're in as of this, while I'm doing this now, July 14th, 2021. You mostly 95% of your positions would be to the long side. There's really not much reason to hedge unless you believe the market's reversing. And I'll get into which stocks to hedge in a second. The second one would be if the market is trading sideways. So we're really going to focus on those two, the market going vertical or having a really strong bullish move to the upside, or more interestingly, where the market's going sideways. We're going to talk about both of those, but the concept that we want to talk about, and I'm actually going to come up to the screen here again, is we show this every day and we walk through sector rotation, and the dominant conversation that we have around sector rotation is, okay, let's focus on which sectors are the strongest right now, and those will be the sectors that we are going to focus on buying. But what we don't focus on at all is the other side of that list, which is the bottom of the list. So what we are essentially talking about here is relative strength versus relative weakness. So if the market's going up, now we're going to take a look at the other side and see which sectors are exhibiting bearish order flow, or which one is seeing a massive supply dumped on the market in those stocks, and they're going down right now. So you have the rest of the market that's going up, or other sectors and stocks that are going up. But we're doing this homework every day. We're creating a game plan, choosing which stocks we want to buy. Now we're going to the other side because now we're in the hedge mindset. And I have to be honest, I have no idea why I keep doing that. It seems like the right thing to do. As stocks are weak and you're recognizing they're weak, you could buy, again, options in those stocks on the way down. They might be a little bit more expensive because they're already going down and going in that direction. So premiums might be a little expensive, but you're paying for protection. Or you could short sell those stocks. So in other words, if you understand short selling, you borrow shares back from your broker dealer. They have them in their inventory. You are essentially doing the same thing that if you bought a put option where you're expecting the price to go down, except when you short sell, there is no time limit. It's essentially you're holding the trade for as long as you think that security is going down. The downside of short selling versus buying a put option is that a put option, you will not lose more than the put. The short selling, there's technically unlimited upside. So you really need to know your game. You really need to have discipline. I just did it again. You need to have discipline to exit if the hedge starts to rally, if the market starts to rally, and really make sure that you are acting like a pro. We call hashtag acting like a pro all the time in our community because I want you to constantly think like a professional does, and professionals don't have emotional attachments to positions. It's see the trade, put it on, see the trade, put it on. If this happens, then I know what I'm going to do. So what Andy would do during the day, whether it's a longer term stock portfolio or if it is an active trader like Andy was over that 1 to 5 day window, he would essentially be building positions on both sides of the market. So if we go over to our favorite scanner, which is FinViz, and start to pay attention here. We're actually going to pull this up over here, and we are going to now go over the last 5 days. Just this is a very simple example. And we're going to take a look at, if the market starts to see selling, we're going to look at pockets of opportunity that had short selling or bearish order flow. Now, if you're not familiar with FinViz, the size of the box is the market cap. The color of the box is whether or not there was bullish or bearish order flow over that time period. So what's kind of cool here is you now know that if you're looking for stocks that have an expectation of following to the downside, whether it's over 1 week, whether it's over 1 month, and you can see the energy stocks over here have taken a hit over the last month, or over the last 3 months, depending on what your time frame is to be looking. You'd see Tesla's a pretty different picture there. It's actually up recently. So what's kind of interesting about this is that you need to know the time frame that you expect to hedge, whether it's buying a put option or whether it's actually short selling stock. But I want to get into what Andy talked about and how he traded, because it's kind of interesting. So let's say the market's going back and forth. He would essentially be looking to build positions on the long side meaning being a buyer, while at the same time paying attention to which stocks were weak at that time. So he was aggressively building positions and buying stock on the way up, but at the same time noticing stocks and sectors that were weak and building tiny short sale positions. So he had trades on both sides. He had longs aggressively because the market had bullish order flow and it was going higher, but he was creating a hedge in case those stocks reversed by building small positions in stocks that were showing relative weakness while the market was going up. So if and when the market turned around, he would exit the long positions, the positions he bought, or hold them. We'll get into both of those scenarios in a second. So as the market started to roll over and saw signs of bearish order flow, he would already have a position in a stock on the short side by short selling. As the bearish order flow, I keep doing that, as the bearish order flow started to go down, he would add to his short position, which would protect against the profits on the long side in the bullish environment. So then when the short sales stopped going down and he made money while those short sales were going down, he would buy those shares back, which would now give him a profit as the market or the stocks went down, and then be able to hold those positions on the way up, it's a very advanced strategy, but it's the same thing that we're talking about longer term portfolio. Andy was just doing it all day, every day, and he would trade millions of shares. Very, very active trader, probably one of the best traders I've ever seen. Him and a friend of mine named Mark. So those are really the trade-offs. There's the cost of buying the hedge, the cost of implementing the hedge. You need to know what time you plan to do it. Are you hedging for a week? Are you hedging for a couple of days? Are you hedging for the next year? You really need to understand what that's going to cost you. And don't forget, you can always go back into cash, but I know a lot of long-term investors prefer to hang on to the position. So that's really a different way of hedging. I think that it's an important thing to consider. I will say you should consult somebody who has done it before, a professional advisor, because it's a cost. It's a cost, and especially if you look to do something like Andy did, which was hedging with short selling stocks or short selling indices, there's a big difference. There's one final way of doing it, which is very advanced, which is if you believe the market or your stocks are going to roll over or go down, there is always the option of selling out of the money call options, but that's a very, very advanced strategy. You really need to know somebody who understands what that means. Very similar to short selling stock, short selling options. In other words, you are selling an out of the money call. If you believe the market's going down, you have unlimited risk on that as well. So those are very, very advanced strategies. So really depends on what you define a hedge, how long you want the hedge to be, but those are three ways to do it. Just really decide what matches your risk tolerance, what matches your skill level, and then really educate yourself a little bit deeper. But those are the primary ways to do it. What's kind of interesting, if you happen to be watching this right now and you're a day trader, the way Andy did it, that was really his trading strategy. He was constantly trading relative strength and relative weakness against each other all day. He wouldn't have big positions on the short side, especially in a market like we're in now, which is a bigger market. It's really it's been very strong for the better part of, let's say, 18 months. But again, he had a lot of buying power. He was trading millions of dollars. He could afford to be hedging all day, every day. Short selling costs a little bit more than buying stock. There's a different margin for that. But it's pretty interesting topic to get into, because if you think about what he did on a very short-term basis, is essentially what hedging a portfolio is on a longer-term basis. So hedging really comes down to what instrument you're going to use and how long you believe you need that hedge. So hopefully, Sophia, this gave you some good insights into answering how to hedge and the ideas of how to hedge. But you really need to pay attention to what time frame you believe you need that hedge, because that time frame will dictate what that hedge is going to cost you. All right. Thank you so much, everybody. I really appreciate it. Have an awesome day. If you have any questions about this topic, please leave a comment below the video. I really appreciate it. Take care now.